This is the Equity Management Academy Mean Reversion Trading Weekly Podcast for January 27th, 2022. The danger is deflation, not inflation. Summary. There is a lot of talk about the Fed possibly raising interest rates 3, 4, or 6 times. Everyone has an opinion. Yesterday, Chairman Powell said interest rates would remain unchanged until the Fed finishes tapering, and then will only raise them a quarter point subject to the conditions of the market. The gap between inflation and interest rates has to be narrowed, which is about 4% negative yield against the US dollar. The yield curve seems to be suggesting that we may go into a slowdown, the opposite of what the hawkish Fed stance is suggesting. Fundamentals. There is a lot of talk about the Fed possibly raising interest rates 3, 4, or 6 times. Everyone has an opinion. Yesterday, Chairman Powell said interest rates would remain unchanged until the Fed finishes tapering, and then will only raise them a quarter point subject to the conditions of the market. It is always subject to the conditions of the market. Since last June, Powell has been talking about the acceleration in prices of commodity assets and other areas. Since then, we have seen a major correction in most markets. Recently, the Nasdaq stocks and the mini S&P have had a correction. There is a lot of fear in the market with the expectation that interest rates are going to pop this economic bubble of artificially inflated assets. If you take into account the amount of stimulus it has put in the purchasing power of the US dollar in jeopardy, its value has declined as the Fed has created more and more stimulus. It's time to take away the free money. The pandemic over the past couple of years has had major effects. We have one of the fastest increases in homelessness in decades. Major cities are inundated with homeless people. Downtown Los Angeles has a block after block of homeless. Every major city in the U.S. has more homeless people than before the pandemic. The pandemic has accelerated the demise of the Western economic system and the US dollar as the world's reserve currency. It is being challenged because of the tremendous debt, close to $30 trillion, that is carrying. The tail end of the debt is set to explode if interest rates do rise aggressively. The danger is inflation. Is it lasting or temporary? Are going back to the levels that the Fed has set as a target of 2 to 2.5% on the 10-year note? In the face of the Fed talking about raising rates, the 10-year note is at 180. The 30-year is at 208, down a few basis points. The bond market appears to be saying that we are not looking at runaway inflation. The yield curve seems to be suggesting that we may go into a slowdown, the opposite of what the hawkish Fed stance is suggesting. In 2018, the Fed raised interest rates a quarter point and the markets collapsed and gold bottomed. The Fed was then forced to backtrack and had to begin to lower interest rates. With the producer price index at about 7% inflation rate, the real return on the 10-year note is negative. Even the 5-year note is in negative territory in relation to inflation. The Fed, therefore, is between a rock and a hard place. Equity Management Academy CEO Patrick MontesDeOca said, they cannot raise interest rates aggressively without collapsing the market. The gap between inflation and interest rates has to be narrowed, which is about 4% negative yield against the US dollar. It is tricky to remove the easy money when the bond market is indicating the possibility of a slowdown. As we move into the second and third quarter of this year, we're going to be watching to see how the economy slows down. The IMF just forecast that the global economy will slow down this year. Omicron will continue to be a drag on the global economy. Just as in 2018, it appears that the Fed raises rates, the markets will respond and force the Fed to stop raising interest rates. Global debt is about 130% of GDP. Such levels are unsustainable, let alone if rates increase. Even a quarter point could devastate the global economy. Russia and other countries are beginning to talk loudly about eliminating using the US dollar as the reserve currency in trade with China. They want to start using the yuan. There is an increasing consensus against the US dollar, which is imploding and causing a level of inflation that we have not seen in 40 years. In 1971, the debt was far less, and the Fed could raise interest rates. For the Fed, inflation will help make it easier to pay down the debt with inflation-depreciated dollars. Even though they talk hawkish about inflation, it is in their best interest to allow some inflation to decrease the impact of the massive debt on the system. Precious metals. Fred Hickey, another 5 tons inflows into the GLD ETF today. That's 37 tons in the last 5 business days. Evidence of U.S. institutional gold buying, which has been missing since 2020. This is the type of buying that drives gold bull markets. End of quote. Relatively speaking, the cheapest assets on the board are gold and silver. GLD is beginning to see an inflow of capital, and that is really positive sign that the money is starting to come into the metal sector. The metal sector has suffered with so much money going into Bitcoin in response to the collapsing US dollar. The currency is imploding, which is reflected in the values of food, commodities, and other essentials. Stocks rose first since 2020, and then gold hit 2089. GLD, the major gold ETF, at the time hit 194 in terms of a risk-reward ratio. Silver and gold are the best assets out there to buy. We see substantial moves in a short period of time. For gold, look for reversions. 1780 and 1800 appear to be the new bottom, and holding these levels should send the market up. If we close below these levels, we may test 1750. But if that is the case, that would be an incredible buying opportunity for gold and silver. Featuring Heckler Mining. Heckler Mining is a precious metals company that creates value for shareholders by discovering, acquiring, developing, producing, and marketing minerals resources at a profit. In 2020, Heckler's Green Creek mine produced 10.5 million ounces of silver, and the San Sebastian mine produced 954,772 ounces of silver at an average cost per ounce of $5.49. The Nevada operations produced 31,756 ounces of gold, and the Casa Berardi gold mine produced 121,493 ounces of gold in 2020 at an average cash cost per ounce of $1,130. Forecasted earnings growth for Heckler Mining in 2022 is 58.3%. Over the last 5 years, Heckler Mining is profitable and is currently in good financial health. Heckler has diluted EPS of 0.04 and a net income of $18.44 million. We really like Heckler Mining, in which we are building a long position. Heckler offers an incredible opportunity to buy and hold the stock over the next year or two. It is the second largest gold producer in the U.S. and one of the oldest silver mining companies. It has the credibility of longevity and is offering an incredible value in terms of price and in terms of intrinsic value. We are at a 61.8% correction from the high in May, June. The stock has the potential to test a high of $9.44. It is an excellent silver asset to buy and hold. It has come down to a low of $4.50 on December 13. Since then, we made a high of $5.09 recently and appear to be building a base at these levels. Taking the Fibonacci retracement from the recent high to the recent low, the market yesterday completed a 23.6% retracement. The 32.8% target is 635. A 68.5% retracement is at 748, and a 78.6 retracement target is 829. If we close above 829, we will challenge the highs of 944 with the Fibonacci extension all the way up to 1230. It appears that these targets will be met in the next 12 months. I strongly recommend accumulating physical gold and silver, MontesDeOca said. You also have a percentage in Bitcoin. These markets are going to be the beneficiaries of a new reality in which interest rates, without any significant economic growth, cannot go up.
Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, ematotrade.com, or listen to any of our previous episodes.